Americans are saving less money right now than at almost any point in modern history. And at the exact same time, prices are climbing faster than they have in over a year. That combination has a name. Economists are terrified of it, and almost nobody in mainstream media is saying it out loud. Two numbers, just two, write them down if you have to. Number one, 2.6%. That's the personal savings rate in the United States as of this spring, one of the lowest levels ever recorded outside of a full-blown crisis. Number two, 4.2%. That's the annual inflation rate as of May, nearly double what it was just 3 months earlier. Now here's the part that should make you sit up. Normally when inflation rises, it's because the economy is running hot. People are spending, businesses are hiring, wages are climbing. That's uncomfortable, but at least it's a sign of strength. This time is different. Wages are cooling, job growth has slowed to a crawl, and prices are still climbing anyway. There's a word for that ugly combination. Economists call it stagflation. And the last time America lived through it, it took over a decade and 2 brutal recessions. To fully dig out, stick with me, because by the end of this video, you're going to understand something that most financial news isn't willing to say directly. The US economy might be quietly sliding into a trap that nobody wants to name. Let's start with the uncomfortable question. Why isn't this the top story everywhere? Part of the answer is political. Admitting that stagflation risk is rising means admitting that policy choices, tariffs, energy shocks, immigration restrictions, interest rate decisions, all carry real economic costs. No administration wants that headline. No opposition wants to look like it's rooting for bad news either. So the word gets softened. You'll hear mixed signals. You'll hear a complex picture. You will rarely hear the actual word. Part of the answer is also structural. Wall Street has a distraction sitting right in front of it: artificial intelligence. Billions of dollars are pouring into AI infrastructure, and stock indexes are hitting highs on the back of that investment wave. When the headline number, the stock market, looks fine, it's easy to ignore the numbers sitting underneath it. But a booming stock market and a struggling household budget can exist at the exact same time. In fact, right now they do. And part of the answer is timing. The energy shock driving a chunk of this inflation followed a period where oil prices had actually started coming down, after tensions in the Middle East appeared to ease. So on the surface, it looks like the worst is behind us. Underneath the surface, the inflation data tells a messier story, one where the effects of an energy spike are still working their way through the system, showing up in food prices, transportation costs, and fertilizer costs for farmers. So no, this isn't a conspiracy. Nobody is hiding a secret report in a locked drawer. It's simpler than that, and honestly more unsettling. It's a slow bleed that doesn't fit neatly into a single scary headline, so it keeps getting talked around instead of talked about. Let's make sure we're all speaking the same language, because this word gets thrown around loosely. Stagflation is the collision of two things that are not supposed to happen together: stagnant economic growth and persistent inflation. Under normal economic theory, these two forces are supposed to counteract each other. When growth slows, demand falls, and prices are supposed to cool off along with it. When inflation rises, it's usually because the economy is overheating with too much demand. Stagflation breaks that rule. You get weak growth and hiring, combined with prices that refuse to come down, sometimes because of a supply shock like an energy crisis, sometimes because of policy choices like tariffs that raise costs directly, and sometimes because of a shrinking labor force that limits how much the economy can produce. Even when demand is soft, central banks hate this scenario more than almost anything else, because the usual playbook stops working. If a central bank raises interest rates to fight inflation, it risks crushing an already weakening job market. If it cuts rates to protect jobs, it risks pouring fuel on inflation that's already running hot. There is no clean answer. Every option carries a cost. That's why you're currently seeing something unusual: a Federal Reserve that is openly divided, with some officials pushing to protect the labor market and others pushing to protect price stability, and no clear consensus on which danger is bigger. Let's walk through the numbers one at a time, because each one alone might not scare you. But stacked together, they paint a much clearer picture of inflation. The headline personal consumption inflation figure sits around 3.5% over the past year. But the more recent monthly trend is what matters here. Inflation jumped to 4.2% on an annual basis in May, up sharply from 2.4% just a few months earlier. That's not a gentle drift, that's a spike, the cause. A large piece of that spike traces back to an energy shock tied to conflict in the Middle East, which pushed oil prices sharply higher earlier this year. Even though prices have pulled back somewhat since the ripple effects haven't fully faded, higher fertilizer costs are expected to push food prices up later this year, and transportation costs remain elevated compared to where they sat 12 months ago. Tariffs layered on top of the energy shock is a separate inflationary pressure. Tariffs. The effective tariff rate on imports has risen sharply over the past year, and estimates suggest more than half of that cost is being passed directly onto consumers. That means a meaningful chunk of the inflation you're feeling at the store isn't just about global oil markets. It's a direct result of trade policy, the labor market. Here's where it gets uncomfortable. Unemployment has climbed from 4.1% to 4.4% over the past year. Job openings have fallen. Hiring has slowed to what some economists describe as a near standstill. Part of that slowdown comes from a sharp decline in immigration, which shrinks the available workforce. But that's only part of the story. Demand for labor itself has softened. Wage growth is still technically outpacing inflation, but the gap is narrowing fast and it's decelerating even as prices climb. That means the cushion protecting household budgets is getting thinner in real time. Savings. And then there's the number that opened this video. Personal savings dropped to just 2.6% of after-tax income this spring, one of the lowest readings in decades. When people have less saved, they have less room to absorb a shock, a car repair, a medical bill, a rent increase. Any of those can turn into a genuine crisis for a much larger share of the population than in previous years. Put those pieces together: rising prices, a cooling job market, thinning wage growth, and almost no savings cushion. That is not a random collection of bad luck data points. That is the anatomy of stagflation. If you want to understand why economists get nervous the moment this word comes up, you have to go back to the 1970s. That decade delivered the textbook case of American stagflation. An oil shock out of the Middle East sent energy prices soaring. Inflation climbed into double digits. Unemployment rose at the same time. The Federal Reserve at the time was slow and inconsistent in its response, cutting rates too early, more than once, only to watch inflation roar back stronger. It took a punishingly aggressive interest rate campaign at the start of the 1980s, rates pushed into the high teens, to finally break the cycle. That cure came with its own brutal cost: a deep recession and years of painful unemployment. Notice the pattern. An energy shock out of the same region of the world, inflation that spikes faster than wages can keep up a central bank caught between two competing dangers. It's not an exact replay, no two economic periods ever are, but the structural ingredients rhyme in a way that should make anyone paying attention a little uneasy. The question that keeps economists up at night isn't whether the parallels are perfect, it's whether policymakers today have learned enough from that decade to avoid repeating its worst mistakes, or whether history is about to test that lesson all over again. Let's zoom into the single most important decision-making body in this entire story: the Federal Reserve. The Fed operates under what's called a dual mandate: keep prices stable and keep employment strong. In a healthy economy, those two goals usually point in the same direction. Right now, they're pointing in opposite directions, and that's an incredibly rare and dangerous position for a central bank to be in. Rising inflation argues for higher interest rates to cool demand and bring prices back under control. But interest rate hikes make borrowing more expensive for businesses and consumers, which, given an already weakening job market, risks tipping hiring from sluggish into outright contraction. On the other hand, a softening labor market argues for lower interest rates to support hiring and business investment. But cutting rates while inflation is already running above target risks, reigniting the very price spiral policymakers are trying to avoid. There is no move here that comes free. Every option is a trade-off between two forms of pain. That's precisely the bind that defined the worst years of the 1970s, and it's part of why you're currently seeing open disagreement among Fed officials about which risk deserves more weight. Some are prioritizing the labor market, others are prioritizing price stability. That kind of visible division at the top of the Federal Reserve doesn't happen during ordinary economic conditions. It happens when the data genuinely doesn't offer a clean answer. Add to this one more twist. Leadership at the Fed itself is set to change hands this year, which introduces even more uncertainty into how this dilemma eventually gets resolved. This isn't a purely domestic story, and framing it that way would miss half the picture. Major global institutions have been quietly downgrading their growth forecasts for the year, citing the same energy shock rippling through the world economy. Global growth projections have been trimmed to around the high 2% range for this year, with warnings that a more prolonged energy disruption could push growth down toward levels not seen since the depths of the pandemic. Inflation across the G20 as a group is now projected to run meaningfully higher this year than previously expected, driven overwhelmingly by the same energy price surge hitting the United States. Emerging markets are getting hit even harder. Countries that rely heavily on energy imports are facing a brutal combination of higher borrowing costs and rising food insecurity, since higher fertilizer prices feed directly into higher food prices. For some of the poorest countries in the world, this isn't an abstract economic debate. It's a direct threat to basic food access. Meanwhile, China is dealing with its own separate but related slowdown. Fixed asset investment inside China has fallen at its steepest pace since the pandemic began, with a sharp contraction in property investment dragging the numbers down. That matters to the US story too, because a slowing China affects global demand, global trade flows, and the broader question of who has the economic leverage in this new era of trade tension. So when you zoom out, the picture becomes even more unsettling. This isn't just an American problem quietly brewing in the background. It's a global energy and inflation shock layered on top of a fracturing global trade system, landing at a moment when several of the world's largest economies are already showing signs of strain. Here's a piece of this puzzle that deserves its own spotlight, because it might be the biggest reason this whole story is flying under the radar. Stock markets, especially those tied to artificial intelligence infrastructure, have continued climbing throughout this period of economic strain. Massive investment is flowing into AI-related equipment, data centers, and infrastructure, and that investment has been a genuine bright spot supporting business investment figures and headline growth numbers. But here's the disconnect worth sitting with. A booming AI investment cycle and a struggling everyday household budget are not contradictions. They can both be true simultaneously. The money flowing into AI infrastructure is concentrated among a relatively small number of massive companies and investors. It does not automatically translate into higher wages for the average worker, lower grocery bills, or a fatter personal savings account. Some analysts have gone further, drawing a direct line between elevated oil prices and inflated AI stock valuations, arguing that expectations about how central banks will respond to inflation are quietly shaping investor psychology around AI-related assets in ways most people aren't tracking. In other words, geopolitical shocks in the Middle East and speculative bets on artificial intelligence in Silicon Valley might be more connected than they first appear. The danger here is a kind of statistical illusion. When the loudest, most visible economic indicator, the stock market, is soaring, it becomes very easy to wave away concerns about inflation savings and the labor market as overblown. That illusion doesn't hold forever. It tends to break at the exact moment people least expect it to. Let's bring this down from abstract economics to something closer to home, because stagflation doesn't hit everyone equally. Lower and middle income households get hit first and hardest. They spend a larger share of their income on necessities, food, energy, housing, which are exactly the categories seeing the sharpest price increases right now. When savings sit at a record low of 2.6%, there is almost no buffer left to absorb rising costs. A single unexpected expense can push a household from stable into financial distress. Renters are particularly exposed. Housing affordability pressures were already a headline concern heading into this year, and a combination of elevated interest rates and persistent inflation makes that squeeze worse, not better. Small businesses face their own version of this trap. They're dealing with higher input costs from tariffs and energy prices, a labor market that's harder to staff due to shrinking immigration-driven labor supply, and financing costs that stay elevated if the Fed leans toward rate hikes to fight inflation. Large corporations, by contrast, often have the balance sheet strength to absorb short-term cost pressure, widening the gap between big business and small business resilience. And workers approaching retirement face a particularly cruel version of this dynamic. Inflation eating into the purchasing power of fixed incomes and savings at precisely the stage of life where there's the least time left to rebuild a financial cushion. This is why the word stagflation isn't just an academic term for economists to debate on cable news. It's a description of who absorbs the pain first when growth stalls and prices keep climbing anyway. And right now, that burden is landing squarely on the households with the least room to spare. There's a specific date worth marking on your calendar because it could be the next major inflection point in this entire story, July 24th. That's when a blanket tariff implemented under emergency executive authority is set to expire, following a Supreme Court ruling earlier this year that found the administration's original use of that authority illegal. The administration has already signaled it intends to pursue a different legal pathway, invoking a separate provision that allows tariffs against countries deemed to be engaging in unfair trade practices. What that means in plain terms, tariffs aren't going away. They're likely being restructured through a different legal mechanism, but the uncertainty around exactly how much and against which countries creates exactly the kind of unpredictability that businesses hate. Companies can't plan investment or hiring decisions confidently when the tariff landscape could shift again within weeks. This uncertainty compounds the stagflation risk directly. Businesses facing unclear future costs tend to freeze, delaying hiring, delaying investment, delaying expansion, which reinforces the stagnant growth, half of the stagflation equation, even as the tariff costs themselves continue feeding the persistent inflation half. So watch that date. Whatever happens around July 24th and in the weeks following it could either ease this pressure or intensify it significantly. And almost nobody outside of trade policy circles is talking about why that date matters this much. It's worth being fair here. This isn't a guaranteed doom scenario, and treating it as one would be dishonest. Several forces could pull the economy away from a true stagflation spiral. If energy prices continue drifting lower, as some forecasts currently project into next year, a major driver of the current inflation spike could fade on its own. If tariff uncertainty resolves into something more predictable, business investment could stabilize. If AI-driven productivity gains genuinely start showing up in broader economic data that could offset some of the labor market softness in a way that doesn't rely on unsustainable speculation. Most mainstream forecasts, in fact, still project the U.S. avoiding a full recession, with growth continuing at a modest but positive pace over the next couple of years, even as inflation remains uncomfortably above target for a while longer. The majority view among economists surveyed recently put the probability of a recession within the next 12 months at around 1 in 3, elevated concerning but still not the base case. The honest answer is that this is a genuine fork in the road, not a predetermined outcome. The ingredients for a serious stagflation episode are visibly present. Whether they combine into a full-blown crisis depends on decisions that haven't been made yet. By the Federal Reserve, by trade policymakers, and by how global energy markets evolve over the coming months. Here's why this matters to you personally, regardless of where you live or what you do for work. If you hold investments, understanding this dynamic helps you interpret market moves that might otherwise seem confusing, like stocks climbing even while economic data looks shaky underneath. If you're a borrower, the direction the Fed takes on interest rates in the coming months will directly affect mortgage rates, credit card rates, and auto loan costs. If you're a saver, a record low national savings rate is a signal worth taking personally. not as a judgment on anyone's spending habits, but as a reminder of how thin the average household's financial buffer has become in this environment. And if you simply want to understand the news you're seeing every day, rate decisions, tariff headlines, oil price swings, this framework, stagflation, is the thread connecting all of it together. Once you see it, you can't unsee it in the headlines anymore. So here's my question for you, and I genuinely want to know where you land on this. Do you think the Federal Reserve should prioritize protecting jobs, even if it means letting inflation run hotter for longer? Or should it prioritize crushing inflation now, even if that risks a sharper economic slowdown? Drop your answer in the comments. Tell me which risk scares you more personally, rising prices or a shrinking job market, and why I read every single comment on these videos. And honestly, some of the sharpest insight in this community comes from the comment section, not from me. If this breakdown helped connect some dots for you, hit subscribe, because this is exactly the kind of story that develops in slow motion, one data release at a time, and I'll be tracking every major shift as it happens. Before you go, one more thing you need to know. Remember that July 24th deadline I mentioned? There's a second, much less publicized deadline sitting just weeks behind it, tied directly to who takes over leadership at the Federal Reserve this year. And depending on who that turns out to be, everything I just walked you through in this video could shift in a completely different direction. I'm already digging into that story right now. It's bigger than people realize, and almost nobody is connecting it to the stagflation risk we just covered. That video is coming next. You will not want to miss it.